The World Bank has downgraded Kenya's economic growth estimate for this year to 4.7%. Now, in its annual report, the lender downgraded the East African nation from its initial projection of 5.5% at the beginning of the year. The report cites the economic hardships Kenya experienced over the past 12 months for the reduction. Most notably, massive floods in April, which crippled agriculture in many parts, as well as anti-government protests against a controversial financial bill some weeks later. The global multilateral lender also pointed to the country's inability to consolidate its finances. Now, earlier I spoke to Naomi Mathenge. She is a World Bank senior economist based here in Nairobi. And she laid out some of the biggest factors that are stifling Kenya's economic growth right now.
So allow me to put this into context. And what the report is pointing out is that it's indeed true that the economy is slowing down. But we also note that while both agriculture and services sector are still show some resilience, they're slowing down and there are risks of further deceleration. What is losing momentum mostly is the industry sector, and especially the subsector of construction. And we're asking ourselves, why is this? So what we've seen is there's a weaker demand in housing amid the high real interest rates. Cement consumption and production have also declined, comparing the first 8 months, that's from January to August this year, compared to last year. We've also seen a decline in imports of iron and steel, which go to the cement, to this sector.
Right.
And again, something that we have seen across all sectors is that the credit to the sectors has plummeted, and mostly for construction firms. So, and overall, there is also subdued investor confidence that is limiting private investments, loss of competitiveness, and low productivity, which are some of the things that we've been looking at, noting that productivity growth in Kenya has been on the negative side.
But let's delve into that improved macroeconomic environment. What is driving that? Do you expect to see that sustained going forward? And how significant a risk is Kenya's debt position to the progress made so far?
So on the macro side, beginning February 2024, we've seen most of the macro indicators improving. And to put it into context, we've seen inflation decline from about 6.9% in January to the current 2.8% in February. We have seen also the exchange rate stabilizing and has depreciated by about 17-18% so far. And also the signal that the central banks sent on a more accommodative monetary policy going forward on the backdrop of a sustained decline in inflationary pressures. So these are the signals we are seeing, and we anticipate that is going to be to continue going forward. Now, if you look at the reserve position, this has significantly improved, and the projection is that this will continue to sustain the stability in the exchange rate. So the improvement in the macroeconomic environment is expected to continue in the near term.
The World Bank is urging the government to tackle structural imbalances. Give us some more insight into what these imbalances you speak of are.
What we've seen is a weaker performance of the export sector, Kenya's exports. And this is as a result of the loss in competitiveness. There's low competitiveness in exports. And we've also seen the low and declining FDI compared to the levels that we've seen in previous years. There's very little product diversification amongst our exports. And as a result, we are saying that boosting exports and seizing the opportunities from trade agreements will open up the economy to FDI and promote more productivity growth across sectors. So that's one imbalance. The other imbalance we note is the productivity imbalance. Kenya's productivity, as I had mentioned earlier, is low and has been negative. The growth has been negative. We have a labor-intensive tradable sector, mostly agribusiness, and in general the manufacturing sector that has grown very little. So that's another imbalance. And then we look at climate imbalances. And we know that even though Kenya does not contribute much to the climate change, it suffers disproportionately more from it. And we've seen the climate shocks that have increased in frequency and even intensity. We had 2 years of consecutive drought, and then after that, it was followed by floods, and this takes a toll on the economy. And then the last imbalance is on the fiscal imbalances. Previously, what we had seen is a growth that was led more by public investment through accumulation of high public debt. And this resulted in the high debt levels that we currently see. So there are high fiscal vulnerabilities, including pressures on the domestic revenues that could undermine the fiscal consolidation effort. So these are the 4 imbalances on the fiscal, the external, the productivity, and the climate-related imbalances.